including what the Nova Scotia Securities Commission is, what we do, why we exist here in Nova Scotia. After that, we'll go into some basic investing information. Things like the difference between saving and investing, because a lot of people don't know that's actually a thing, that there is a difference between the two of them. We'll look at some of the registered accounts available in Canada that you can use to save and or invest for certain goals you may have, whether it be short, medium, or long-term goals in your life. We'll look at some specific types of investments, including equities, bonds, mutual funds, and ETFs, exactly how those investments work, how you can invest in them should you choose to in the future, how they can potentially make you money, and how they can also potentially lose you money as well, because there is always risk involved with investing. And we'll also talk briefly about crypto assets in that section as well, talking about how it's currently regulated here and how you can, as safe as possible, invest in those assets should you choose to do so. Then we'll finish off by taking a look at investment fraud, including some of the fraud numbers here in Canada over the last number of years. We'll take a look at the red flags of investment fraud you can look out for if you're ever approached with an investment opportunity that would help you spot it as a fraud and hopefully avoid it. We'll look at 3 specific types of fraud that we've seen a dramatic increase in here in Nova Scotia and throughout Canada, including pig butchering, unregistered trading platform promotion, and impersonation scams. So let's jump right in. We'll talk about how securities regulation works here in Canada. Every province and territory in Canada has a securities regulator. In Nova Scotia, that's us, the Nova Scotia Securities Commission. We regulate all securities and derivatives and anyone connected to those type of products here in the province of Nova Scotia, whether they be selling, advising on, or issuing securities. Security can include any type of investment product like a stock, bond, a mutual fund, or an ETF, for example, as well as more complex things like derivatives and investment contracts. And we'll talk about some of those basic ones today in the presentation. I'm going to briefly skip over that part just to talk about what the Nova Scotia Securities Commission is and why we exist for Nova Scotians. According to the laws of Nova Scotia, on paper, our mandate is to provide investors with protection from activities that undermine confidence in the fairness and efficiency of Nova Scotia capital markets, and we're not inconsistent with the best protection to foster capital formation. That is the boring legal definition of what we do according to the laws of Nova Scotia. What that essentially means is we regulate, protect, and educate investors in the investment industry here in the province of Nova Scotia. We regulate, as I said, regulating all securities derivatives and anyone connected to those products here in the province of Nova Scotia. We protect by issuing alerts, warnings, and cautions around suspected illegal activity or people issuing, whether it be fraudulent or illegal or unregistered securities that, if bought or invested in by Nova Scotians, could cause them, in some instances, dire financial harm. And we educate by providing educational materials, both online, in print, and in person to Nova Scotians to help them make more informed, safer investment decisions. One important note, one thing we do not do is we do not provide investment advice. Employees of the Commission are not allowed under a mandate to provide investment advice. What I mean by that is, if you were to come to myself or another employee of the Commission and say, should I buy investment A, should I buy investment B, should I go with this advisor or this firm, that is the not kind of advice or information we provide. That is to be provided by either an advisor, or we can provide you with educational materials and information to help you make a more informed, safe decision for yourself. But we do not provide investment advice the same way an advisor or financial institution would. Skip over the definition and get right to the meat of the presentation. On the screen there, you'll see a number of terms that are involved in investing in finance. You may be familiar with some of them. You may not have any idea what some of them mean at all. And we're going to talk about most of these today in the presentation. If you don't have a great grasp of finance or investing right now, it's probably okay, because you're probably early on in your life, early on in your financial management. But what we don't find okay, which unfortunately we see quite regularly, is people that have been investing or managing their money for many, many years, decades even, who are using these type of products or using these type of accounts without having any basic knowledge of how they work or if they're actually right for them or their individual situation. So if you don't have a great grasp on finances, it's okay. Pick out a few of those terms. Again, we're going to go over most of them today. Learn about what these products are, what these accounts are, what they're used for, and how they can be used for you and as an individual, and how they're good for you or potentially not good for you, because just because something's good for another person doesn't necessarily mean it's right for you as an individual investor. So now we're going to talk about some really basic investing basics, starting out with the difference between saving and investing. Because there is a difference between those two terms, despite the fact they're often used interchangeably and sometimes misunderstood by people that are actually saving and investing currently. Does anyone actually know what the difference is between saving and investing? Okay, if you don't, we're going to go over it. I always like to ask just in case. But typically, when saving is when you save money, you put money aside that is readily accessible there, should you need it or have a specific goal for it. Investing is when you put money into some type of investment vehicle, many of which we're going to talk about today, stocks, bonds, mutual funds, for example, with expectation or hope that over time that money will grow and create money without you actually having to do anything. Another good way to look at the difference between saving and investing is what the difference between if you were to save $2,000 or if you were to invest $2,000. So let's say I have $2,000 and I'm thinking about saving that money, meaning I'm just putting it aside. I could put it in a safe in my home. I could potentially put it in a savings account with a bank. But typically with savings accounts, you make often so little interest. Sometimes you'll pay more to actually open an account and maintain it than you will with earnings you'll achieve from the money you're actually holding within it. We're not saying there's anything wrong with saving. The main issue with saving money is, talk about that $2,000 we had. Let's say I saved that $2,000 5 years ago in 2020. I have an envelope in my house that I put $2,000 in that's there, readily accessible should I need it for some reason or I have a goal set for. The only problem is due to inflation, which you may have heard a lot about recently because we've been in a time of heightened inflation over the last number of years. Due to inflation, the purchasing power of money decreases over time. So when you save money, I always have my $2,000. It's right there. I have $2,000. But what I can buy with $2,000 in 2025 is sometimes considerably less than what I could have bought with it in 2020, especially around goods like food, gasoline, and other tangible goods, of which we see in some instances a dramatic increase in prices. So inflation decreases the purchasing power of save money because it does not grow over time. You may have $2,000, but what I can buy with that $2,000 now is much less than when I potentially started saving it 20 years ago. If I invest that $2,000, I put it in some type of investment vehicle. But again, the expectation and hope that I will keep up with or surpass inflation, either maintaining or increasing the purchasing power of my money. I want to be able to buy at least the same amount of goods or more, hopefully more goods or more, whatever I want to use it for in the future. I want my money to grow and make money on its own, again, without me having to do anything. And as I said, saving and investing both have their place in your financial management. But you need to make sure you're saving for the right things or investing for the right things, or you may not be able to achieve and reach those goals you set for yourself. So for example, on our left-hand column here, we have our savings bucket, things that fall into the savings heading that you can actually save for in your life. A lot of people will save what's known as an emergency fund, put aside a few $1,000s typically, or whatever you're comfortable with, to have readily accessible again, should an emergency happen. Pipe burst in your home, which actually happened to me over the summer, flood in my basement. Thankfully, we had an emergency fund to help some of the costs that came along with that. Your car breaks down, your pet needs emergency medical attention. If you have an emergency fund, you have money there, again, readily accessible to tackle those challenges, which unfortunately, as you get older, they happen more often than you would like, more often than you think they're going to. So you don't have to dip into your investments and potentially derail your investing. You can also save for something like a computer, for example. That's, again, a tangible, readily accessible goal over a short period of time. Let's say I want to buy a computer that costs, say, $1,000. I could save $100 a month for 10 months. And most likely over that short period of time, inflation will not increase the cost of that good so rapidly that I will not be able to, again, meet that savings goal I set for myself. A lot of people often save for an annual vacation. They'll take a certain amount of money off each paycheck and maybe set it aside in a different account or some type of savings area so they can go away once or twice a year on that vacation. A lot of people often save for something like a car down payment as well. Maybe they want to put down $4,000 or $5,000 next time they buy a car. So they'll save a certain amount of money every month or every so often to try and, again, achieve that savings goal they set for themselves. On the right-hand side there, we have our investing goals, which are often more long-term, higher financially costing goals you set for yourself. Things like purchasing a house. Housing costs, as you're probably familiar with, have gone up quite considerably in this part of the country and throughout most of the country over the last number of years, meaning that down payment that you want for your first home is going to be considerably more than it might have been, say, 5-10 years ago. So a lot of people will invest, and there's a specific account that has been created actually in the last few years for that, which we're going to talk about during our accounts portion of the presentation, to help people invest in more easily or quickly reach that savings, or excuse me, investing / savings goal for that down payment of their home. A lot of people will invest for post-secondary education because for a number of people that can be one of the highest cost expenses in their lifetime, as you're probably aware how costly post-secondary education can be these days. So people often invest for that to help reduce that cost burden. And a lot of people, most people, pretty much everyone has to invest for retirement due to the fact that savings will not allow them to achieve the goals that they potentially will set themselves to retire comfortably. And another way to look at that, why investing, saving alone is not often enough to achieve these high financial goals, is by taking an example of trying to save $1 million. And by save, we're talking about simply putting money onto a pile, and the pile only gets larger when you put money in it. You're not investing in that money. It has no growth ability of its own. It only grows when you put more money onto the pile. So let's say you are 20 years old, you want to retire when you're 60, and you think you're going to need $1 million to do it. Saying that's enough necessarily, but it's a number people throw around a lot. And it's also a number that people can often picture in their heads quite clearly. So if you were 20 and you wanted $1 million when you're 60, just by saving money, that would give you 40 years to achieve that goal. But to actually achieve it over those 40 years, you'd have to save $25,000 per year, or just over $2,000 a month. I don't know your financial situation, but I know myself and everyone I know, at the end of the month, after they've paid rent, mortgage, transportation, food, whatever other bills and costs they have, and whatever else they want to do for fun, no one I know has an extra $2,000 at the end of the month they can just set aside and save for 25 years to try and achieve that $1 million goal. And unfortunately, through statistics we have been released through Stats Canada, we know the average Nova Scotian has no ability to do that either. For 2023, for example, the after-tax household median income in Nova Scotia was just over $62,000. Take $25,000 out of that to save, you're probably not going to have enough money left over for that rent, that mortgage, that other lifestyle costs that you have for yourself. Minimum wage in Nova Scotia rose to $16.50 in October of this year. If you have a minimum wage paying job that works 40 hours a week, 52 weeks a year, your take home pay before taxes per year is just over $34,000. Again, there's no way you can save $25,000 when you barely make that much after taxes and deductions. So again, this is an extreme example just to show that large financial goals you set for yourself, investing for most people has to be part of it, because simply saving is not enough, not possible to reach those goals you may set for yourself. And now I'm going to move on to talk specifically about different types of investment accounts and different types of investment products and what the difference is between those. So in our little graph here on the left-hand column, I think that's the left for everybody, is our investment accounts, registered investment accounts that are available here in Canada to all people to use to save and invest for certain goals they set for themselves. We're going to go through each one individually. You don't need to look at the information on the screen necessarily, because we're going to go through each one individually to talk about the structure of them, what they're used for, and how they can potentially help you achieve certain goals. And on the right-hand side, we have our investment products, many of which, again, we're going to talk about today, can be held within these accounts to take advantage of the benefits that come along with them. Going back to the accounts, a number of people are often confused with how these accounts work, often because of the way they're promoted and advertised by financial institutions, specifically with the RRSP, for example, which is the first one we're going to talk about. RRSP, which stands for Registered Retirement Savings Plan. As the name suggests, it's an account you use to save and invest for your retirement, meaning any money you put in this account, you probably will not see for another 20, 30, 40 years, depending on how old you are and when you expect to retire. So it is a registered account used to invest and save for retirement. There's often some confusion about RRSPs, again, due to the way it's advertised or promoted by financial institutions, especially around tax time in January and February of each year. So typically around that time of year, you'll see ads on TV, radio, or online, or even in print these days sometimes, where financial institutions or advisors will say, the RRSP contribution deadline is coming up, which is typically the end of February every year around that time. And you need to get in, meet with your advisor or meet with your bank to buy some RRSPs before the deadline. And the reason that's confusing is because an RRSP is not a tangible product. You can't go to a bank or an advisor and buy RRSPs. They are not a financial product. RRSP is an account that holds other investments in cash inside it to take advantage of the benefits that come along with it. So a lot of people that are out there that have an advisor or have an RRSP think they're going out to their advisor and buying RRSPs actually buying probably mutual funds or ETFs or some other type of investment fund without having any idea that's what they're purchasing, that's what they're investing in, because they believe, fortunately, and I was in this camp a number of years ago, that an RSP was a thing you actually bought. But in fact, an RSP is an account that holds those other things inside it, again, to take advantage of certain benefits. The way an RSP works, you receive a contribution limit, meaning you can contribute a certain amount per year to an RSP based on your income of the previous year. And that comes out to either 18% of your income or $31,560, whichever number of those is smaller. And that number does change occasionally, but this is what it is for 2026. When you contribute to an RSP, you put money into it, you receive a tax deduction on your contribution on your taxable income for that year. So how that works, for example, let's say I make $50,000 a year, meaning I will be taxed on that $50,000 when I declare my income taxes. If I contribute, say, $5,000 to an RSP, I can deduct that $5,000 off my taxable income, so I'll be taxed less. So instead of being taxed at $50,000, I'll be taxed at $45,000. Since most people pay their income tax throughout the year, a little portion is taken off pretty much every paycheck and sent directly to the government, so you don't need to worry about yourself by sending a lump sum at the end of the year. That means the government has essentially been taking too much money from you. They've been taxing you at 50%, but due to this deduction, you're only supposed to be taxed 45%, 45,000, excuse me, meaning you will setting yourself up for an income tax deduction. Income tax refund, excuse me. Typically, most people that receive income tax refunds achieve that often by contributing to an RSP over the year. RSP is considered to be what is known as a tax deferred account, meaning all growth, the money inside it is tax deferred, meaning when you retire, when you stop working and you need money to continue to live, that's when you start withdrawing money from your RSP. Typically at the time, you will convert it to what is known as a registered retirement income fund, or RIF. When you start withdrawing money from an RSP, you have to declare that as income and you'll have to pay tax on it. How much you pay will determine how much you withdraw and what tax bracket you fall under. Typically, older persons often have less income than working people. They also have access to other tax deductions and tax benefits and may help them reduce that tax burden. But it is important to be aware that when you contribute to an RSP, be aware that when you withdraw during your retirement, you will have to declare it as income and you will end up paying tax on it. Next, registered account in our list of accounts is the Registered Education Savings Plan, or RESP. As the name suggests, this is an account used to save and invest for post-secondary education. Some of you may have had one opened by your parents a number of years ago, and you may be using that money to currently pay for your schooling as we speak. So similar to an RSP, too many R's. Similar to an RSP can hold cash and eligible investments inside it, meaning you can buy mutual funds, ETFs, other type of investments, hold them within an RSP, again, to take advantage of the tax benefits that come along with it. There are other contribution limits connected to this account as well, as were with the RRSP. The contribution limits to an RSP is there is no maximal annual contribution limit. You can put as much annually as you would like, as you have the ability to do so. But the lifetime contribution limit is $50,000. The maximum you can put in this account overall is $50,000. Dissimilar to an RSP, contributions to an RSP are not tax deductible, meaning when you contribute to an RSP, you cannot use that contribution to deduct from your income. It's not allowed, it's not part of that account. It is also a tax deferred account similar to an RSP. What that means is the investment growth within that account, meaning you hold investments and they grow over 10, 15 years or however long you'll open the account to help pay for that child's education. When that money is withdrawn, and it will be withdrawn to pay for tuition, books, or other schooling costs, the beneficiary of that money, the person going to school and using it to pay for education, has to declare the growth within that as income when they use it. Typically, students, again, have much lower income than working people. They also have access to certain tax benefits and credits that may help reduce that tax burden to very little or sometimes not at all, again, depending on how much they declare and what their income bracket happens to be. So RRSP used for education payment for college or university. There's also certain federal programs that will help match contributions to an RRSP. Canadian Education Savings Grant, for example, will match up to $7,000 of contributions, giving you up to $7,000 of free money to contribute to this account to help, again, pay for that education cost down the road. Next in our list of registered accounts is the TFSA, or tax-free savings account. It is a registered account for individuals 18 years or older to invest money tax-free. That is not 100% correct here in Nova Scotia, due to the fact that here in Nova Scotia, the age of majority is 19 years of age, meaning in this province, you legally cannot sign a contract, meaning you cannot legally open a TFSA until you turn 19 years of age. The reason it says 18 is because in a few other provinces, for example, Quebec and Alberta fall into this category, the age of majority is 18. So if you reside in those provinces, you can open a TFSA, unfortunately, a year earlier than you can here in Nova Scotia. Despite the fact you can't open a TFSA in this province until you turn 19, you do start gaining contribution room immediately on your 18th birthday. How that works is every year, the federal government will announce the annual contribution room for the TFSA. They announced 2026 just last month, and it is going to be $7,000 again in 2026, the same way it was in 2025. What that means is you can contribute up to $7,000 next year to your TFSA and either leave it in that account as cash, or use that money to buy investments and hold it within the TFSA, again, to take advantage of those tax benefits. Any contribution room you don't use is carried over, meaning if you've been 18 since 2009, since the TFSA was first introduced, you have approximately just over $100,000 of total contribution room. Contributions to a TFSA are not tax deductible, as they are with an RRSP, meaning when you contribute to it, it does not deduct from your taxable income. That being said, what does make it a powerful and useful account is that all growth and withdrawals within that account are tax-free, meaning if I buy some investments, hold within a TFSA, they do very well and make money, I will not be taxed on that growth. When I withdraw money to use for whatever purpose I want to use it for, you will not be taxed on that either. Everything from growth to withdrawals to deposits are all tax-free within this account. There are a few places where people are sometimes confused with how a TFSA works. One of those being, how does growth within the account affect your contribution room? And the short answer to that is that it does not affect it at all. So let's say, for example, I have my $7,000 of room. I get $7,000 of contribution room in January. I immediately contribute $7,000 and I buy some type of investment to hold within that account. That investment does quite well, and by March, the total balance of my account is $7,500, meaning I'm $500 over the contribution room. Has that affected it? Am I in trouble? Again, the short answer is no, because growth within the account has no effect on the contribution room. The only thing that affects contribution room is contribution itself. If growth had an effect, then it would kind of remove any ability to use the account whatsoever anyway. When you withdraw money from TFSA, another thing that's sometimes confusing to people, when you withdraw money, say I withdraw, say $1,000 from my TFSA, you will regain that contribution room, that $1,000, on January 1st of the following year, and no, not before. There are some people that have gotten in trouble with this in the past, believing that they regain that contribution immediately, and they have contributed more money than they are eligible to do so. If you do contribute more money, say you have $7,000 room and you contribute $7,500, that is considered to be over contribution. Anything you could over contribute by will be penalized by the CRA 1% per month until you reduce that contribution back below the contribution threshold. So if you are 19 or 19 or older, you may want to look into opening a TFSA, because again, it can be a very powerful and useful account to save for short, medium, or long-term goals completely tax-free. The last registered account we're going to talk about, which is also the newest one that was just introduced a few years ago, is the FHSA, or First Home Savings Account. As the name suggests, it is a registered account used to invest and save for the down payment of your first home. FHSA is kind of a mashup of the RRSP and TFSA, because it has specific characteristics both that have been combined to create one specific new type of account. It also has certain contribution limits. The contribution limits on FHSA currently are $8,000 per year, or a lifetime contribution limit of $40,000. FHSA also has a time limit on how long you can keep it open, which is currently 15 years from the day you open it. That 15-year clock begins when you open it. It has nothing to do with your age. Doesn't matter how old you are when you open this account, you have 15 years to hold money inside it and 15 years to use that money as a down payment. If after 15 years, which has not happened yet because the account's only been around for about 3 years, if after 15 years you have not used that money for a down payment, you can either potentially withdraw it and potentially pay taxes on it at that point because it wasn't used for its initial purpose, or possibly roll it over to a TFSA, which again has not happened to anyone yet because we have not reached 15 years of being in existence. Due to the fact this account is still relatively new, it may be possible for these numbers or limitations to potentially change in the next few years as it's reviewed to see how it's being used, how useful it's been. So be aware and keep an eye out if you open one of these accounts that it is possible this could change in the future due to the fact that it's still new and is still under review. Similar to an RSP, contributions to an FHSA are tax deductible, meaning similar with an RSP, if you contribute to an FHSA, you can reduce your taxable income with your contributions. And similar to a TFSA, all growth and withdrawals from these accounts are tax-free, meaning when you put investments in it and it grows, you won't pay any tax on it. When you withdraw the money to use as your down payment on your home, you will not have to declare as income. You do not have to pay any tax on it. So if you're thinking about purchasing your first home sometime in the future, an FHSA might be right for you to, again, help you shorten the period of time to get reach that potential down payment level you want to reach. So those are our registered accounts: RRSP, RESP, TFSA, and FHSA. Each, again, has their certain uses and certain tax benefits that come along with them. And again, that may make them valuable to certain goals you set for yourself. On the right-hand side here, we have our investment products, many of which we're going to talk about now, including cash and currency, which is simply cash, which you can, again, hold within any of these accounts. Our securities, which are things we regulate as a securities regulator, including shares, stocks, bonds, GICs, mutual funds, and other investment funds and ETFs. And we're going to go over each of those in a minute to talk about how they specifically work. Cryptocurrencies are currently a bit of a gray area. They may be securities, they may not. We're going to talk more about that as well. But also, cryptocurrencies out of that list are currently the only for sure you cannot hold within a registered account as an investment. Meaning, if you own Bitcoin or Ethereum or any other type of crypto asset, it is not an eligible investment on its own to be held inside a registered account to take advantage of those benefits. The only way you can currently hold crypto assets within a registered account is buying an ETF, like a Bitcoin ETF or Ethereum ETF, that invests in those assets that is eligible to be held within an account to take advantage of tax-free savings account, for example. Derivatives are complex, complicated investment contracts that have the ability to make you considerable amounts of money very quickly, but due to the high-risk nature of these types of assets, they also have the ability to cost you considerable amounts of money very, very quickly as well. So if you're interested in investing in derivatives in the future and want to learn more about them, I recommend you either have vast knowledge about them if you're going to invest in them, or have the guidance of a well-known, smart advisor who has experience with these types of assets to guide you and help you along the way. Because due to their high-risk nature, it is possible to lose, again, considerable amounts of money very, very quickly. And lastly, we have what are known as insurance products that also fall under the investment product heading, which include things like segregated funds, life plans, and annuities. These are not securities, they're insurance products, but the fact that they exist out there, that if you work with an investment advisor that is also an insurance salesman in the future, for example, he or she may recommend to you segregated funds, for example. And we include it in our product list because we want to make sure people know that these, one, are real investments, they are legitimate, they do exist. They just aren't securities. They aren't regulated by us. But again, it's possible you could encounter them in the future if you're with an advisor that is also an insurance salesperson. So now we're going to go through a few of these type of products specifically and look at, again, how they work, how they can potentially make money for you, also the risk involved with the potential of losing money. Starting out with equities. Equities, also known as shares or stocks, give the purchaser a stake in a publicly traded company or business. This is a company, essentially, that has gone public, allowing people to buy shares within the company to become an owner of the company and potentially take part or share in the profits of that company. When you invest in equities, you typically will make money, if possible, one of two ways: by having your equity stake increase in value, meaning the price of your shares will increase, allowing you to sell those shares for more than you paid for them to make what is known as a capital gain. Capital gains are not guaranteed. investment, and there's no guarantee that the value of a company will go up over time. Many do, but many also do not. So if you were to sell an investment for less than you paid for it, then you would potentially take a capital loss. The other way people potentially can make money by investing in equities is receiving a dividend payment from the company they're investing in. So we're going to look at some basic examples of how both of those work to see how, again, you can potentially make money by investing in equities. We'll take a look at an example of how a capital gain works by looking at Google, for example. Everyone has obviously heard of Google. It's one of the most successful, somewhat profitable technology companies that is available to be bought. It's a publicly traded company that trades on New York Stock Exchange. But when Google first went public back in 2004, when they first offered shares to the public to buy, to invest in their company, they had an IPO, which is an initial public offering, which is when shares first become available to the public to buy, at $85 per share. Meaning back in 2004, if I wanted to invest in Google and I had, say, $850 on IPO day, I could have bought approximately 10 shares in that company. If you were to look at the valuation of Google shares earlier this month, you would have found them trading on this day at around $285.34. And you may be thinking, $285 up from $85 in 21 years, that doesn't sound like a whole lot of growth for a company as successful and as profitable as Google. And you'd be right in that because over its 25 years as being a public company, Google has done what is known as 2 stock splits. When you do a stock split, the price overall, the listed price of your stock decreases, but the overall value does not. So for example, last time Google did a stock split was in 2022 when they did a 20-for-1 split. So for every share you owned before the split, the day after you own 20. 1 share becomes 20 shares. The day before the stock split took place, Google shares were selling at $2,200 per share. The day after the split, they were selling at $110 per share. The reason the split was done is because it makes the shares more liquid, makes it more accessible to more investors. Because, for example, how many investors can probably buy 1 share for $2,200? Probably not a lot. But I imagine a number of investors available to buy shares for, say, $110 is much more higher than obviously it's going to afford $2,200. The thing is, the overall valuation of the shares does not change. The way that you can, an example of how that would work potentially to better explain how that works. Let's say I owned 10 shares in a company and those shares are worth $100. That would mean each share I own is worth $10 per share. Let's say that company that I own those 10 shares in is decided to do a 2-for-1 stock split, meaning for every share I own, I will now have 2 shares after the split. So I had my 10 shares that are worth $100. After the split, I would have 20 shares that are still worth $100. The overall value of my shares still remains at $200, but the price per share has dropped to $5. So the valuation of the company does not change. Simply cost of the shares change, again, make them more liquid, more accessible to certain other investors. So when you take in the stock splits to consideration of Google's stock price and stock evaluation, so due to the stock splits, those 10 shares that I bought in 2004 are equivalent to just around 399 shares in 2025, which also means the shares that I spent $850 for in 2004 are now worth approximately $113,850 in 2025. Meaning, if I chose to sell my shares at this time, I'd be looking at a capital gain of nearly $113,000. Again, this is an extreme example. There aren't a whole lot of Googles out there. There aren't a whole lot of companies that will show that much growth in a short 20-year period. But it is an example to show how capital gains can potentially work. Again, there's no guarantee that companies will go up in value. It can also go down, causing you to lose money. There's also no guarantee that what goes up stays up. Many companies that have shown tremendous profitability and growth over periods of time have lost that considerably and caused people that are looking at a massive capital gain to potentially run into what is now a capital loss. Now we're going to look at how receiving a dividend works with investing in equities. Dividends are profits that are allocated to shareholders should the company choose to do so. Public companies are not required to pay dividends. A number of them do not. Companies are not required to maintain or keep their dividends. Many companies will raise the dividend price, some will decrease it, some will cease it entirely if the profitability of the company becomes an issue or ceases to become profitable whatsoever or at all. A good example of how dividend stocks works Here in Canada is CN Rail, Canadian National Rail. According to experts, it is considered to be one of the most reliable, safest dividend-paying stocks that trades on the Toronto Stock Exchange here in Canada. CN Rail pays their dividends quarterly, meaning they pay their dividends to their shareholders 4 times a year. So they just recently announced their fourth quarter dividend, which will be paid at the end of December of this year, which is the end of the fourth quarter of this year. They announced that their fourth quarter dividend payment will be 88.75 cents per share, meaning as long as I hold any shares by the ex-dividend date, which is declared at the same time that they declare what their dividend payment will be, for every share I own, I will receive 88.75 cents on December 30th, 2025. And you may be thinking, that doesn't seem like very much money. Wow, it's not even $1. What can I do with, if I own 1 share, I wouldn't even get $1. What am I going to do with that? But if you own considerable amounts of shares in a company that pays dividends, it can potentially add up to considerable amounts of money, sometimes very quickly, depending on when you buy those shares. So for example, does anyone know who one of the most single largest investors in CN Rail is? Sorry if you don't. I've only had actually one person answer this question correctly in the entire time I've been talking about this over the last year. But it is that guy, Bill Gates, for anyone who doesn't know, which I'm assuming everyone does. But Bill Gates, under his Bill Gates Foundation, is one of the largest individual shareholders in CN Rail. And if you're interested in what else he's invested in, you can Google Bill Gates portfolio, and it will show you, not on a daily basis, but will show you what else he's invested. So for example, Bill Gates, as of November of this year, owned 54.8 million shares in CN Rail. So what that essentially means, and he's owned those shares for many, many, many years. So what that essentially means is, when CN Rail does their fourth quarter dividend payment at the end of this year, Bill Gates and his foundation will receive a dividend payment of approximately $48.6 million for the price of what his shares are currently valued at. And as I said, that's quarterly, meaning that's be the 4th time this year he's received that money just for owning those shares. So if you want to know one of the ways that rich people continue to get rich is by putting their money sometimes in dividend paying stocks and getting money coming in for them doing absolutely. I mean, of course, to own that many shares, it costs $7.5 billion, which obviously is beyond anyone I'm expecting anyone in this room's reach. But even if you were to own 100 shares, you'd be paid $88 every quarter. You can potentially roll those shares over. So if you're interested in investing in equities, it's up to you to determine, do you want to invest for capital gains? Do you want to invest for dividends? Do you want to invest for both? It's up to you to determine what risk you want to take on and how you want to potentially make money in these assets. Again, should they be money-making assets at all? So now we're going to move on to talk about another type of investment product, specifically bonds. A lot of people have heard about bonds, but a lot of people not necessarily know how bonds work or what happens when you actually invest in them. Bond, by definition, is a loan made to a government or company that is secured by the government's treasury and ability to tax or by a company's assets. So when you buy a bond, essentially you are loaning your money to either the government or a company, depending who's actually issued that bond to the public. And that company or government is promising to pay you back your initial investment, the money you've given them, plus interest at a certain period of time at a certain interest rate. And that time and interest rate is set when you purchase that bond. So let's look at an example of how a basic bond typically works. Let's say I'm buying a $1,000 bond. It has a 5% interest rate that is compounded annually, meaning I receive interest not only in my investment, but also on my gain interest as well. And it has a 5-year term. So I will not receive my money, my principal plus interest, for at least 5 years. So after 1 year, the interest on this bond would be $50. 5% of 1,000 is $50. If it's a 5-year term, at the end of my 5 years, everything being compounded all those years, you receive $1,277. You receive your $1,000 back plus $277, which is 5% interest compounded over those 5 years. That is basically how a typical bond works. You purchase the bond, you determine how long you want to hold it, and what interest rate is being offered you by the issuer. Typically, the longer you hold a bond, the more interest you receive. Also, depending on the rating of the bond, meaning how risky it is for potential default. What I mean by that is, say you issued a bond by a company, that the bond term is 5 years, and you're expected to see your money in 5 years, but that company, say they go bankrupt, in default, and go into insolvency after 3 years, you may receive no money from that bond. So when bonds are issued by companies or governments, They're issued a credit rating, which will determine, again, how solvent the issuer is and how risky it is about you buying that bond, about if they could go insolvent and potentially cause you to lose your investment. There are many different types of bonds out there. They're what are known as strip bonds, which pay the principal or coupon at a different point. There are what are known as real return bonds that may match inflation or other type of interest rate. There are what are known as index bonds that, again, may index a specific index or other rate. And there are bond funds, which we'll talk about in a minute when we talk about mutual funds. If you're interested in investing in bonds, be sure you know the interest rate, the term, and any stipulations that may be connected to when you'll receive the money you're investing. Now I'll move into talk about a different type of investment product, specifically mutual funds. Mutual fund, by definition, is an investment product made up of a pool of money collected from many investors, which invest in a collection of stocks, bonds, or other securities, and is managed by a professional investment fund manager. So when you buy a mutual fund, you are buying one product that is a combination of many different securities within inside it. It could be a bunch of equities, it could be a bunch of bonds, it could be a combination of those two products. It allows you to potentially invest in multiple areas by buying one thing. It also allows you to potentially diversify your portfolio, again, by buying one product. As it says on the screen, when you buy a mutual fund, you are joining a pool of investors that is always already invested in the fund. Mutual funds are open-ended, meaning as many people can join the pool of investors as they want to. They just issue more funds as more people line up to invest. What is made up of the mutual fund is decided on and managed by a professional investment fund manager. He or she will look at the fund on a regular basis, typically daily, and determine what should be included to best maximize the returns of the investors investing within it. Centered on the guidelines connected to what should be or what can be invested in that actual fund. And that is determined by what type of mutual fund you purchase. The type of mutual fund will determine what it's made up of, and other things around risk factor and potential for return, also potential for loss. Also, for example, money market funds are considered to be the lowest risk of all mutual funds out there. They're investing in short-term fixed income securities, typically low interest paying, low risk bonds. So if you're looking somewhere to park your money that's typically relatively safe, money market funds is a place a lot of people typically go to do that. That being said, due to the low risk in them, that also means lower returns when compared to other investments. Fixed income funds, again, as the name suggests, invest in fixed income securities, bonds typically issued by governments or corporations. Again, typically very low risk, can be potentially higher than money market funds, but due to the low risk nature, often pay, again, very little returns, sometimes compared to other types of investments. Growth or equity funds, as the name suggests, equity funds invest in equities, stocks, and other companies. The risks involved with equity funds can be anywhere from low to high to sometimes even extreme, depending on what you're investing in, what type of companies, how risky those companies are. Balance funds, as the name suggests, is a balance of equities and fixed income securities, meaning you're investing in both stocks and bonds by buying one product. It could be completely balanced, 50-50, could be 80-20, either way, 60-40. The makeup of the fund will again determine the risk and potential for returns, as well as determining on what is actually investing in. Global funds, as the name suggests, invest in foreign equities and foreign and fixed income securities, meaning equities issued by companies outside of Canada or bonds issued by governments or corporations or companies outside of Canada as well. And those, again, could be solely equities, could be balanced funds, depends again on the makeup of the fund, which again determines the risk factor, the potential for returns, and potential for losses. And lastly, we have index funds, which are funds that mimic a specific type of index, such as the S&P 500 or S&P TSX Composite, meaning you buy index funds typically for the long term, because you know in the long term, those indexes are going to go up. They may not go up over a week, they may not go over a month, but over multiple years, you expect the the TSX, for example, the S&P 500, to go up in value. If you have your index fund, make you money. It may take you years sometimes. These days, it's not as short as it used to be, but we've been in a heightened state of inflation in the valuation of these indexes. But index funds are typically determined to be long-term investments. If you're buying mutual funds, you will pay fees. All mutual funds have fees. How much you pay will be determined on many factors, partially due because of what is known as the management expense ratio. All mutual funds have an MER. MER is listed out as a number and a percentage, which is a percentage taken often directly right off the returns, which is paid to the person managing the fund. It is important to know what that number is because it can be anywhere from decimal point number to 3 to 4%, again, depending on the management of that fund. Embedded commissions are commissions that when you purchase a fund are paid directly to either the issuer of the fund or the salesperson that is selling you that fund. You may not actually see that on your statement. So if you're buying mutual funds in the future, it's important to know, again, not only what the MER is, to also ask if there's any embedded commissions in there that may cost you money when you invest in those funds. Loads are paid when you either buy or sell a fund. In fact, now they're all paid when you buy because selling them has been disallowed in this country as of a few years ago. So load is a fee you will pay, again, either to the money manager or the issuer of the fund when you buy it. When you purchase mutual funds, it's important to know what funds you're paying, how much those funds are potentially cutting into the returns that you are receiving on those funds to determine, again, if a fund may be right for you or may not be right for you. Now we'll move on to talk about ETFs, exchange-traded funds. ETFs, as they're commonly known, is an investment fund traded on a stock exchange that holds assets such as stocks, commodities, or bonds, which track an index or specialize in a specific sector. You may think just by looking at that definition, isn't that the exact same thing as a mutual fund? And yes, ETFs and mutual funds are similar in the fact that they are one product combined up of many types of securities that again allow you to invest in multiple areas by buying one product. However, there are some major differences between ETFs and mutual funds that may make one a better investment for you than the other. As the name suggests, exchange-traded fund. An ETF is traded on an exchange. It trades on the TSX in Canada or the New York Stock Exchange in the US, for example, which also means the price of it changes on a regular basis when the markets are open, meaning you could purchase it at its traded price whenever you want when the markets are open. Mutual funds do not trade in an exchange. If you buy a mutual fund, you will pay the cost of its closing value on the previous day. It does not change throughout the day. You are able to buy it at its current price because the current price is what it closed at on the previous day. Because they are bought and sold on an exchange, ETFs must be bought and sold by a broker, whether that be a person or an app on a smartphone or a computer laptop, for example. ETFs do not have a minimum initial investment threshold. For example, in a mutual fund, if you look at a fund facts document that lists information about a fund, it may say minimum investment $1,000, $2,000, or $5,000, for example. Meaning if I want to enter the pool of investors invested in that mutual fund, I need that minimum amount to actually invest. ETFs, since they trade in an exchange, whatever they're currently trading at, say they're trading at $5, if I have $5, but whatever commissions needed to do that trade, I can buy one unit in the fund. If I have $10, I can buy two, I can buy 4 for 20. However much money I have that I want to put toward that fund, I can buy as little or as much as I want, as long as I have enough money to cover the transaction. And lastly, ETFs typically have lower fees and have no loads. Due to the fact that they often mirror or mimic an index, they require less management and thus have lower fees. They have an MER the same way a mutual fund does, but typically for ETFs, the MER can be much lower than it can be for mutual funds. We're not saying just because they have lower fees, they're better for you, but it is one thing to consider when determining whether you want to invest in ETFs or mutual funds if you're looking at investment funds as an investment, because it could potentially save you a lot of money over long periods of time should you be investing in these funds for many, many years. Now we're going to move on to crypto assets, which was added to this presentation a few years ago due to increased interest in these assets and increased trading of these assets. You're probably familiar with a number of types of crypto assets. Most people are familiar with Bitcoin and Ethereum because they are considered to be the most mainstream and the most talked about. But there are also many other types of crypto assets, including Litecoin, Dogecoin, Cardano, Ripple, and the list of available crypto assets is growing considerably on a daily basis, including things like meme coins, which are considered to be risky and very extremely volatile. The price of a crypto asset can change in seconds, minutes, very, very rapidly, causing oftentimes considerable great gain in value, but also oftentimes considerable loss in value in very short periods of time as well. Crypto assets may or may not be a security, meaning the laws and rules that abide or that are connected to things like stocks and bonds may or may not apply to crypto assets, depending on if they are deemed to be a security or not. For example, Bitcoin and Ethereum, consensus is in this country among regulators that they are not deemed to be securities. They are deemed to be commodities and are taxed and regulated as such by not only regulators, but also the CRA. Despite the fact that Bitcoin and Ethereum are not deemed to be securities, the trading of these assets on a crypto asset trading platform is deemed to be a securities transaction, and thus crypto trading platforms, CTPs, now, as of a few years ago, must be registered with securities regulators to legally operate in this country, to legally offering trading or advising service to Canadian residents. So as of today, there are currently 16 crypto trading platforms that are registered with regulators here in this province and throughout the rest of the country. They include BitBuy, Bitvo, Coinbase, Coinbase, CoinSmart, CoinSquare, Crypto.com, Fidelity Digital Assets, HiBit, Kraken, Endax, NetCoins, Newton, ShakePay, Virgo, CX, and Wealthsimple. These are the 16 platforms that have agreed to abide by rules and regulations we put in place to, as best possible, protect Canadian investors when investing on these platforms and investing in these assets. It does not reduce the risk around volatility, but it does reduce the risk around fraud and other potential collapse of these platforms and other losses that have caused, again, considerable loss investing in non-registered platforms. There's a list of these registered platforms on our website. It is regularly updated whenever a platform becomes registered. For example, Kraken and Crypto.com became registered earlier this year. They are the most recent additions to our registered list. It's currently at 16. As of 2 years ago, it was at 11, for example. I wouldn't be surprised if that grows to somewhere between 20 and 25 in the next couple of years. So if you're interested in investing in crypto assets, we recommend you use a registered platform to avoid not only potential fraudulent activity and potential losses of that nature, but also to ensure who's operating it. We know that they're abiding by rules and regulations we put in place to, as best possible, protect investors. Speaking of fraud, we're going to move on to talk about investment fraud right now. There is an organization in this country called the Canadian Anti-Fraud Centre, or CFAC, which is an organization that collects and reports on fraud data in Canada on an annual regular basis. In their most recent annual report for 2024, it was reported that Canadians lost $310.5 million to investment fraud in 2024. That was up slightly from the losses in 2023 and up considerably from reported losses in 2021 and 2022. The key word in that statement, though, is reported, because this is only losses that are reported to law enforcement, regulators, or the CFAC itself. It is estimated that only approximately 5 to 10% of actual fraud is reported to any of those organizations. So it's estimated that $310.5 million is probably closer to the $2 to $4 billion mark of losses to investment fraud in this country in 2024. If you're ever approached with an investment opportunity in the future, there are a number of red flags you can look for to help spot it as a potential fraud and avoid it, and avoid what can be at times dire financial losses. The number one red flag being the promise of high return for low risk, or even worse, high return for no risk. If you can remember, there's no such thing as a high return, low risk investment. You can avoid the majority of the investment frauds that are out there, because this is the number one hook, number one lure that fraudsters use to draw people into investing in fraudulent investments. There's no such thing as a high return, low risk investment. The ability for high returns always comes with higher risk. One goes up, the other goes up as well. Anyone who tells you otherwise is either lying to you or offering you a most likely fraudulent investment that will cost you considerable amounts of money. Number two red flags: you must act now or be given no time to think it over. High pressure sale tactics are another major calling card of fraud. I need your answer by 5 o'clock tonight. It's a short-term, one-time, lifetime offer. I'm collecting money from 20 people. I have from 19. I have one spot left. If you don't give me your money now, you're going to miss out on, again, this once-in-a-lifetime opportunity. Fraudsters don't want to give you time to think it over, because they know the more you think about things, the more chance that you're going to say no and walk away. If someone is giving you a short time to think about an investment, that's a major red flag that they don't want you to think about it. They just want your money. They want to get away from you as quickly as possible with it. Fear of missing out is also being used as a tactic these days quite considerably. They'll make you afraid that, again, you're going to miss out on this once-in-a-lifetime opportunity. They'll approach a group of people, single you out and say, everyone else in the group is investing. They're all going to get rich. You're going to miss out, be the only poor person. They want you to not think about, they want to think about what could happen, and not in a good way, not in a bad way. And again, separate you from your money as quickly as possible. Number three, you're being given confidential or inside information. Confidential information is often suspect because typically there's no way to verify if it's actually real or true or not. And obviously fraudsters lie. It's how they make their money. It's how they do their business. Number 4, there's no credible source that can validate the investment. This is connected to what are known as boiler room scams. It's when fraudsters sell investments or investment opportunities in companies that actually don't exist, that are fake fraudulent, that have no reality in existence in reality. So if the only credible source that you are being offered or can find that validates the existence of an investment, a company or a platform or anything you're investing in, that's a major red flag. For example, if someone's offering you to invest in a on-the-ground company that's on the way up, that's going to make considerable money in the future, and you cannot find any information, it's not listed in the joint registry of stocks, it's not listed anywhere else, all they're doing, all the only thing you're provided is their website or media stories provided by them that look fishy and are probably made up, that's a major red flag that you're investing in something or have the potential to invest in something that is not real, doesn't exist, and again, will simply cost you all of your money should you invest in it. Last major red flag is the firm or advisor is not registered. You sell or advise in securities in the province of Nova Scotia, you must be registered with the Commission to legally do so. That's very easy to check. There is a registration database on our website that holds the name of all registered persons, firms, and companies here in Canada that are, again, are legally allowed to offer investments. If a person tells you they're not registered, that they don't require registration, that's a major red flag that they're operating without the purveyance of regulators, and they're probably most likely offering what is unregistered, fraudulent, non-existent securities or investments. Here in Nova Scotia, we have seen over the last number of years 3 major increases in 3 different types of investment frauds that again have cost Nova Scotians in the upwards of millions of dollars in losses. Those being pig butchering scams, the promotion of unregistered websites and trading platforms, and the proliferation of impersonation scams. So I'm going to talk about one of these briefly. We're quickly running out of time, unfortunately. Pig butchering scams start out with an unsolicited message sent to you either by text, social media app, dating app, or some other type of messaging app, whether it be something like Telegram or WhatsApp. Oftentimes it will look like a wrong number message. I'm sure you potentially get those on a regular basis because I know I do. Someone trying to engage you in a conversation. If they're successful in doing so, they will try and engage you as a friend. And oftentimes they will become a close friend of yours that you will talk to on a regular basis, oftentimes daily or multiple times a day. If they're successful in building that friendship, along the line, it could be weeks, sometimes even months later, because this is often a very long con. They will tell you about a recent investment they've made in some type of crypto asset that has made them considerable amounts of money. And they will try and talk you to investing as well, talking about things like how inflation is so high, everyone could use an extra income stream, who can use more money. And then if that still doesn't work, they'll say, just invest, say $100 or $200 to get started. It's not a big risk to losing $100. Try to give it a shot. If they're successful in getting you to invest, they will provide you a link to either an online platform or they'll get you to download some type of software to your mobile device or computer. Then they will help you step by step create your account, deposit your $100. And then about a week later, you will be shown an account balance or statement showing tremendous growth of that money in a short period of time. Your $100 may have grown to say $1,500 in less than a week. And then your friend will say, wow, you turned $100 into $1,500 in 5 days. Then if you'd invested $10,000 or $50,000, you'd be on your way to millions of dollars by now. And they will try to talk you into investing more and more on the platform. What the person doesn't know is everything the person is telling them is fake, made up. Everything about them, where they are, nothing they've told them is true, nothing they've told them is real. The platform is fake, numbers is being shown as fake, the growth is fake, there is no actual investment. But they will try and talk you into investing more and more. If you don't have money, they'll try and talk you into taking a line of credit, maxing out cash withdrawals on your credit card, or borrowing money from friends and family potentially. And you'll continually be shown a rising account balance in your account. Eventually, people want to withdraw some of that money. In fact, we've seen people who've deposited $50,000, $60,000 being shown account balance of $3 to $4 million, again, of money that does not actually exist. But when they submit a request to withdraw money, they will be told that they have to pay some type of tax for you to have the money withdrawn instead of. And if you're looking to withdraw $50,000, $60,000, someone tells you to pay $1,000 or $2,000 in a tax or fee, most people won't even think twice about it. They'll simply pay because they know they're going to get $50,000 immediately anyway. Tax fee is made up as well. Even if it's paid, no withdrawal will be processed. Typically at that time, they'll be cut off from the platform, never to be heard from their friend or the platform ever again, having lost all of that money. We have had people in Nova Scotia lose in excess of $300,000 individually to these types of scams. And overall, we know they've lost millions and millions of dollars in Canada, and billions of dollars have been lost worldwide to these particular train scams. Every country, every province, every territory, every state throughout North America and throughout the world. Second most prominent type of investment fraud we've seen these days is the promotion of fraudulent trading websites and platforms. According to the CFAC, more than 50% of investment fraud reported to them since 2019 in Canada has been connected to fraudulent crypto trading websites. According to our Enforcer division, 50% of complaints to us has been related to fraudulent crypto trading websites. And we issue alerts and cautions, warnings about these sites on a regular basis, which can be found on our website and social media channels. So to raise awareness of these fraudulent platforms, which are, again, costing people considerable amounts of money, how these are being promoted is through Google keyword searches, promotional ads on social media sites and other websites, promoting platforms and websites as great places to go to buy and sell and trade crypto assets. So to create awareness of the dramatic amounts of losses that these fraudulent platforms are causing to Nova Scotians and Canadians, in March of last year, during Fraud Prevention Month, we created our own fraudulent trading website called novacrypto.ca. Go to novacrypto.ca, you will see the website on the screen now. In creating this website, we studied about a dozen fraudulent sites we've issued alerts and warnings for in the past. We copied their structure. Many of them look very similar to this. We copied their wording. We copied direct text from their website and dropped it onto our website. So anything you find on the website that's a misspelling or looks weird, it is intentionally put there because it was found on an actual fraudulent site. Receive spelled IE backwards, affordable spelled with a T instead of a D. Those are actual mistakes and red flags we found on sites. Major difference between our site, obviously, is we're not stealing people's money. If you go to novacrypto.ca and you click on any link that has to do with signing up, depositing money, or downloading an app, because typically that's where the fraud begins, when they have your information, you have your money, you'll be redirected to the Nova Scotia Securities Commission site where we say Nova Crypto is fake. If this was a real fraudulent site, you would probably be on your way to losing potentially considerable amounts of money. And we outline on our reveal site all the red flags we've intentionally put there, whether they be spelling mistakes, fake testimonials, fake regulatory information, as well as a link in information toward registered platform list, the benefits of using registered platform to, again, protect yourself from what is essentially people stealing people's money left and right by running and operating these fraudulent fake platforms. So Nova Crypto remains up. We've renewed the domain for another 2 years, so we're going to continue to leave it up and promote it and talk about it in talks like this and through our web platform. So go to the site, take a look at some of the red flags, click on the link and go to the reveal site. Share it with your friends and family to help people become aware of these fraudulent sites, to help avoid them, to help avoid what, as again, has been some tremendous amount of losses by individuals here in this problem. Last one, I'm trying to go through this as quickly as possible, is impersonation scams. Impersonation scams, you've probably seen a deepfake video once or twice in your life because they're becoming very prominent these days. In the middle here, in this square box, is a screen capture of a video that was posted to YouTube a couple of years ago. It was remained on YouTube for quite a long time before YouTube security finally removed it. The video supposedly depicted an interview between Elon Musk and Tucker Carlson at some type of technological conference. Elon Musk is on the screen on the stage, and Tucker Carlson is supposedly interviewing him. The interview is supposedly about a quantum AI stock picking tool that Elon Musk has created that is guaranteed, 90% guaranteed to pick winning stocks and guaranteed to make people money. And in this video, he was offering it to Canadians at this point in the juncture. The issue is this interview never took place. The video was fake. Everything about it is fake. Nothing in this is real. Quantum AI stock picking is fake. Doesn't exist, is not real. Nothing in it is real. But despite that, it was viewed almost over 445,000 times. And many people left their contact information in the comment section saying, please contact me. I will invest right away to make as much money as possible. There's many variations of this Elon Musk video out there on any social media platform you can think of that is being used to draw people into this quantum AI stock picking tool that does not exist, that is costing people considerable amounts of money. They're also doing deepfake videos that are using Mark Carney these days. There's a deepfake video out there offering investments in the Canadian government that are all fake. And unfortunately, every time I do a presentation these days, someone comes and say, this is real, right? Because I sent the money. And unfortunately, I have to tell these people time and time again that these Mark Carney videos are not real. You're not investing with the government. They're not sending you crypto assets. You basically lost whatever money. And I've talked to women and that have lost $40,000, $50,000 to these types of scams in excess of that. On the right-hand side of the screen there, you'll see pictures of Arlene Dickinson. Arlene Dickinson, you may be familiar from her. She's been on the CBC show Dragon's Den for a number of years. She's a prominent, well-known, successful Canadian businesswoman. She posted these pictures in posts on her LinkedIn profile last year, warning people that people were using her face, her reputation, and her name to promote their investment opportunities or businesses. Despite the fact she had no connection to them, she had no idea who they were, she had no idea what the product was about. And these are very common as well, using people like Arlene Dickinson, Prime Minister, presidents. They've also actually become very regional centric. For example, last year, they used these type of ads targeting Nova Scotians, using Sidney Crosby as a person promoting some type of opportunity. So in the future, if you see a video or an online ad that's either static or a video using a famous face or an influential, well-known person promoting an investment opportunity or a business or something to make money, often crypto assets, 99.9% of the time it's fake, it's fraudulent, none of it's real. The person that is being depicted typically has no idea it's been done. They're being used to sell these investment opportunities either. So remember, in the future, when it comes to investing, it sounds to be true, whatever it is, it probably is. You should avoid it, as you can unfortunately see people lose considerable amounts of money in this province in this country in the last number of years. So if you want more information about the Commission, connected to some of our investor education content, or links to the registration search database, or links to novacrypto.ca, that's our website, nssc.novascotia.ca. We're going to relaunch a new website sometime in February or March of next year, so keep an eye out for that. Our website will hopefully look a lot better. It's 14 years old right now, and it looks it. If you have a question after today, that's our general inquiries email that goes to myself. I can disseminate your question, whoever the Commission is best suited to answer it. We are currently on several social media channels. We have an X account, but we don't use it anymore. We just keep it up to avoid impersonation scams. But we are on Facebook, LinkedIn, Instagram, and Blue Sky. We also have a YouTube channel where we have just over 80 short 1 to 5 minute animated videos on basic to investing topics. And we've also recently started to do reels and shorts on Facebook, Instagram, and YouTube shorts. So I know I've gone over time, but if there's any questions in the room, or if I can try and see on the chat, maybe I can try and answer those. I think I might be able to see it. 902 number who's tried scamming us about a phone bill discount. So if you get spoofing, it's unfortunate. It's very easy to what's known as a spoof a phone number these days, meaning I can make it appear that I'm calling from Nova Scotia or Ontario, despite the fact I'm calling from Middle East, Asia, Russia, anywhere in the world. I can make it look like I'm calling you from across the street if I want to. Unfortunately, that type of fraud, we don't investigate that. We only investigate frauds involving securities investments. So if you want to report a number like that, it should be done to either RRSP or your local police detachment, depending where you are in the province, and possibly the CFAC, Canadian Anti-Fraud Center, as well. And you might want to block the number, but unfortunately that doesn't help as much these days due to the fact that they can simply make it look like they're calling from a different number. But especially if it's around text messages, if you get an unsolicited text, we do recommend blocking that person. Don't engage with them, don't reply, because most likely they're unfortunately looking to infiltrate a big picture scam or some other type of brand reliant scam line.
Perfect.
When I was very new here, I got a text. They were like, I'm willing to give you a job. And I was like, okay. And then I was about to get scammed.
There's some, and yes, there often will try and get you to send them money or send them money. There's also what's recent increase in what's known as money mules. People will offer jobs about transferring money from one person to another, essentially they're getting you to launder money for them, which is often money that is paid through some type of criminal enterprise or illegal activity. So by transferring that money, you're actually breaking the law by moving illegal money from one person to another. So, I mean, we don't arrest, we don't, because we don't do that in general, but typically people that are let off because unless they know they're doing something illegal, we don't want to come down on them. But unfortunately, there's been a large increase of people using regular people, especially in this country, due to the fact we can easily transfer money through e-transfers quite easily, as opposed to having to go through something like Zelle or something like that in the United States. So if someone ever contacts you saying, or if you're on a platform, they're like, can you help me transfer some money from one person to the other, and I'll get you to keep a percentage of it for yourself. They're most likely looking you to launder illicit money from them, which again is a crime, unfortunately, and they're looking for you to help them move illegally gotten money into some other account or some other area.
They were sending me, it was like what, $800, and my bank, it just stopped the account. That's why I was like, it's a scam. But thank you. Then one more question.
Okay.
What is the process in buying shares with Google or Apple?
If you want to actually invest in those companies, for example, you need to create an account on a brokerage. For example, it could be one with your bank, like TD, Scotiabank, all have their own investing platforms. If you want to do it yourself anyway, or you can do something like Wealthsimpler, Questrade, for example. Those are types of a brokerage offering accounts. You can create TFSAs through those, invest in those. You would go create your account, deposit some money in it, and use that money to buy shares within that company and hold them within your account. How much you can buy does often depend on how much money. It will completely depend.
Any other questions?
Oh, that'll list, like, this won't let you buy and sell. This is your Apple stock. It'll show you.
No, the money you earn on your investments don't count as contribution to the FSA.
You don't.
Only amounts that you originally deposited.
Yeah. These are stocks and bonds. I mean, you're
More than welcome.
following.
Thank you for attending.
With their value, but that's not.
Thank you. It was so insightful and interesting. Thank you so much.
You're more than welcome.